Happy Friday, everybody. Welcome to another exciting May 15th edition of Rate Desk. I am your host, Michael Thomas, here to talk about multifamily interest rates, among other news. Jumping to the markets, they are up on the day. Good to see that. Not quite to where they were about a week ago. We are seeing crude oil move quite a bit back up, now breaking into the 29 a barrel range, inching up towards 30 a barrel. Will that happen next week? Boy, that'd be great to see. Jumping over to U.S. Treasury yields, they have come in just a little bit. 62 basis points, 0.62 today. Before I get into the interest rates on FHA and GSEs, want to mention the reason we're seeing a lot of price stability among the Feds being a big buyer of U.S. Treasuries are Wall Street traders have set floors, okay? I sound a bit like a broken record quoting rates. However, that's a good thing because it brings stability to the housing markets. And if you recall, that is the mission of HUD. Also, GSEs, they want to provide that liquidity and that stability. So that's one way we're getting to it. Going into the interest rates, 223F, FHA fixed for 35 years at 250 today. That is 2.50. The 40-year construction sub rehab, 315 fixed for 40 years. And over on the agency desk, very quiet there today. Not much movement this week, flat to yesterday. Quoting 320 on the Fannie Mae product, DUS, and on the Freddie Mac, still 320 to 335. Now, I want to talk to you about a couple things. One, just quick, I want to mention, saw another news article about an Orlando development of multifamily 292 units breaking ground. That's good to see. Mentioned yesterday, there was a land acquisition, now breaking ground 292 units in Orlando, Florida, part of a master plan community that is transit-oriented development. Also, what we call TOD, but I know you know that already. Of course you do. You're developers. So, jumping into other news. One thing I want to mention, I don't talk a ton about things in specific vertical markets like healthcare, senior housing. I'm going to do more of that in future episodes. But of note, I just want to talk about unrated bonds right now are dead. Talk to several bankers that trade in this space. These can be infrastructure bonds. They could be senior housing bonds. They could be hospital bonds, all in smaller markets or not as financially strong as the rating agencies want to see. Hence, they are unrateable. They're just not alive right now in today's market. Triple Bs are on the lower end of the spectrum of rated bonds. They are trading anywhere from 5.25 up to 550. Not great pricing there. Just want to mention HUD FHA insurance does provide liquidity to those markets as well with debt products that do get you the equivalent of a really, really great AA rating because of the FHA endorsement. That adds a lot of security to it, and people like to see that. Marcus and Millichap, they're a big company, and they're reporting that they think it's a cash crunch on multifamily and properties in general for the next couple of years. And after that, they don't see any kind of valuation issue. It's all a short-term projection on that. They also are seeing that valuations are lower, meaning the maximum loan to values are much lower than they were before. I could have told you that. I just did tell you that. However, I'll mention, again, remember on the HUD programs, they're statutory. You know when they say it's going to take an act of Congress to change that? Well, that's just like HUD because there's a lot of statutes in there. So they don't change their LTV, but what can they do? Well, they can change their requirements in other ways. Hence the debt service reserves I was talking about. I'll give you an update on that next week on what real world is. They did publish 9 months debt service reserve. So while they can't change the loan to value, that would still be 80% in a cash out scenario. They can request and require more money set aside. So they're mitigating their risk, but they're not really changing the LTV. Interesting, huh? See how that works? Okay, next up, I'm gonna talk to you about a couple exciting speakers I have and interviewees I'm gonna have on future episodes. I'm gonna shoot for doing these on Fridays. I've got an investment banker, just like I promised, to come talk about negative interest rates. That's right, he was a trader at Goldman Sachs. He's an investment banker currently at a mid-sized super regional bank. and he's going to tell us in plain English what this all means. Also going to have an investment banker that talks about low-income housing tax credit pricing and credit structures, as well as cash collateral, bond structures. That is one way affordable housing developments are getting financed. He will be coming on a future episode, as well as a general contractor that works nationwide, does senior housing. I think that's going to be interesting to hear about. How are they getting jobs done and what do they cost? How are they getting subs to the site? That's all I got for you today. I wish everybody a happy weekend, happy Friday. Thank you for tuning in to another edition of Rate Desk. This is your host, Michael Thomas, signing off.